Welcome to Kitco News. I'm Niels Christensen, and welcome to our continuing coverage of Mines and Money Online Connect Virtual Mining Conference. Today, we're talking to Joe Mazumdar, editor of Exploration Insights. Joe, welcome to the show. Thank you very much for being with us today.
Thanks for having me, Niels.
So let's jump right into this. We're staring down the barrel of $1,800 gold. A lot of projects look good at these higher prices, but I'm sort of wondering, even if a project looks good, should it be built at these prices? Have we learned from the sins of 2011?
Well, I guess the gold companies right now appear to have learned from the sins as they continued to use U.S. gold dollar reserve prices of about $1,200, $1,250. That might come up, and now we're seeing feasibility studies ramping up to about $1,400. But the question really is, how do you finance these projects, and are the people that are funding these projects going to be using $1,700 gold price or $1,400 or $1,500? That's really the question. But retail and potentially institutional equity like the leverage that these sort of marginal projects provide. So if you like that, I'd recommend go for liquidity. Go for companies with good working capital, and hopefully they never build it. So, it's the opposite of Field of Dreams. Don't build it and they will come.
Okay, so what do you think? What's the state of the mining sector then? I mean, is it, we've actually seen a really good rally off of the lows that we saw in March. So is money coming back into the sector?
Definitely. I mean, the thing is that we saw the sort of same thing for different reasons in 2008 during the global financial crisis. When I was working with Newmont, we saw, a big drop in the gold price. But at that time, gold companies were really concerned about their financial state because they didn't know where they were going to get money from. They pulled back on all their capital expenditures and exploration, everything. But this time, financially, a lot of the gold companies are in a better spot. What we're seeing is the reaction more from the base metal companies in terms of pulling back capital and things like that. But financially, the gold companies are in a much better state. They've taken their write-offs. They've got their gold reserves at about $1,250, and obviously gold is like at $1,750. So those sort of companies have done really well. You could double with a Barrick, from mid-March, or a Newmont. So, but now I think what we're seeing is that has played out to some degree, and now we're seeing it going down to the mid-tiers, the junior producers, and we've seen a lot of recapitalization. I mean, historically, not a big number, but still, in terms of what we've seen later, the industry's been down so long. I mean, this all looks up to them, I guess. But we've seen a lot of financings come out of exploration companies, but mostly gold, mostly precious metals, and silver has picked up as well.
So we were talking offline, and I thought this was interesting. You saying, money's flowing back, but maybe not from financial institutions. What does this mean for the mining sector if banks aren't playing a role in the capitalization?
So banks potentially would play a role in bigger diversified companies that have less of their risk in one asset. The single asset ones, if we focus in on that are developing, the question is, are the banks, what kind of price deck are they using? And I can guarantee you it's not 1,700. So if your marginal project barely makes a double-digit IRR return at around this price, then it's hard to see how the banks would actually lend you money. But what we have seen is private equity playing a larger role in developing a lot of these single asset companies. But what ends up happening is the liquidity dries up in those sort of companies and they don't trade much. So it's hard for retail or anybody else to make a lot of money off of those because they don't trade very much.
So obviously, the mining sector, we're coming off the COVID lockdown. Does the higher price make up for the lost production that we've seen, lost exploration? What are your thoughts on the state of the market that we're in right now?
Yeah, that's an excellent question because, when COVID happened, when we were going to PDAC, it was hitting China very hard, and the industrial production in China, which was, around 5 to 7% on a monthly basis, had dropped to negative 13 to 14% for January and February. And so that hit everything. And then as we were going into March, we were starting to see that obviously on base metals, but also gold plunged. But then as the pandemic moved to the Americas, the biggest impact was on the supply side. So two of the biggest Latin American countries that have been impacted have been Chile and Peru. And so that's impacted copper, and Peru and Mexico as well as impacted silver prices. The COVID impact is, like you said, like restricted and production, especially not so much in the first quarter. We should see a bigger impact in the second quarter, and depending on the company, the price may mitigate the loss of production. It all depends on if your asset is remote, and if it's remote, it might be harder to get back. And whether operationally it's an open pit or an underground, people tend to be closer together. Social distancing a bit harder. And also from a processing standpoint, these mines have to continue, the plant's got to keep working. You can't shut it down. So if you could feed it low-grade stockpile or keep the heap leach going, there's a way to mitigate a bit of the drop in revenue during the lockdowns.
So going forward, I mean, COVID has sort of changed everything, like the way we look at and the way we do business and stuff like that. And I'm sort of wondering, what are you looking at companies now for, like sort of in this post-COVID environment? What attracts your attention?
Well, again, very good question, because that adds a different layer of execution risk, let's say. So people, let's say, we stick to precious metals, people are getting money. Money seems to be less of an issue right now. So, but once they get money, I look for, can you actually spend it? So where are your people? Are they in one country and your assets in a different one? And so how long do you have to wait till the borders open up? The less risk that you have to take that's uncontrollable, the better. So, the companies that are doing well for me are the ones that have got money and also have people that can work right now. They're currently drilling, they're currently doing exploration, they're generating news flow. The problem is when you give money to a company and they're sitting there waiting to actually do something, they're only burning G&A. So that's something you should look for when you do these investments, and especially private placements where you're going to have to hold it for 4 months.
Okay, last question. M&A activity. I mean, we've seen a lot of activity there. China has been aggressively buying gold projects. What are your thoughts? Do we continue to see more M&A? Are Chinese companies the ones to pay attention to for when it comes to the buyers in this market?
Yeah, about a year ago or more, the big wave of M&A was actually from the Australians, because they were seeing a higher local gold price. Their equity was doing well, and they had cash, and cash is important in terms of completing transactions, and they started buying a lot of assets in the Americas. That wave has dissipated. The next wave right now, and it's not as if the Chinese haven't been buying assets before, but now it's making a lot more news. The difference for me is that before, it seemed to me that the Chinese M&A was single bid. They take the asset, not much of a premium, and they wouldn't compete with anybody. Now it seems like they're a bit more aggressive, like Guyana Goldfields. I think it was Shandong, I think it was. That there was 3 bids on that, and they came over the top. They also came over the top on Namdini, on Cardinal's asset in northern Ghana, on top of Nord Gold. So that is a lot. That's more aggressive than I remember it before. These projects tend to be on the edge a bit with respect to either technical or execution risk, but they're advanced, and the key is for it to be advanced either in feasibility study range in reserves like Cardinal, or in producing like Aurora, and that's definitely their window. But geopolitically, they don't go to the same places that Western companies tend to go. So it's a bit of a different dynamic.
So if we do see aggressive bidding and we see sort of asset values go up, is that a good thing for the mining sector at this point? I mean, because we have seen
absolutely. I mean, cash bids by Western companies is a sign that we got a really good market. But we've been seeing cash bids by Australians who are ASX listed who need to do it, and by Chinese companies that are Hong Kong or Shanghai listed that also need to do it. What we do see is a lot of like friendly takeovers. Everything's pliable. People are capitulating. They want to sell their assets, one, because they're tired of operating it, two, because they'll never be able to raise the money to build it. And you've got people with the financial wherewithal to actually put in that money and resolve some of that risk.
Joe, this has been a fantastic conversation. Thank you very much for your time today.
Thanks for having me. I appreciate it. Cheers.
Thank you for watching Kitco News. For all our coverage at Minds and Money Online Connect Conference, go to kitco.com. Stay safe and stay healthy.